Hello there and welcome to The Value of Everything. I'm pleased to have with me Martin North. He is the Principal Analyst of Digital Finance Analytics. Welcome to the show.
Good to be here.
So, on a side note, the first time I actually ever saw you was an interview stroke debates with Paul Boxham. He always seems to get wheeled out. He's an economist for HSBC, and you seem to shout at the TV going, no, 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 and you were there to come back at him and say, no, you're wrong. We was talking about rental prices, and rents was linked to affordability, and you just saw his face drop in the background.
Yeah, that was quite a fun little gig, actually, that one. And he and I had some quite interesting, quite polar views. I think it made quite a good little show.
Yeah. All right. So I think we're just going to go straight into the deep end. We're going to obviously go into Australia and Australian property. But cutting into the chase, do we have liar loans holding up Ponzi-financed housing bubble?
Well, there's no doubt in my mind that we have liar loans. By that I mean, and I think you probably mean, that essentially there are porkies in the system. Now, those porkies could come from individuals effectively overrepresenting their income or underrepresenting their expenses, or it could be in translation from the applications via the broker or direct to the bank, those going into the system in different parameters. We saw from the Royal Commission, there's a lot of evidence now that effectively through the journey of applications, some of that data was changed. In some cases, they even use falsified documents. So we definitely have a sleeping problem relating to fraudulent and liar loans in the system. And it's hard to quantify, of course, how big that is and what the impact is. But I think it's probably fair to say that if you look today at the mortgage power, in other words, how much you could borrow based on the simulators on the websites, it's 20% less than it was a year ago. So that tells you something about the way that the underwriting standards have changed and the way that the focus on, the more detail around applications. And Westpac, of course, this week announced the fact that they were now drilling down into a much greater deal of granularity around particularly expenses. So, yeah, we have a problem. That has definitely inflated home prices. It's definitely lifted the risks in the bank. The question is, do we have a bubble? Well, I guess a bubble is defined as a short-term spike likely to pop at any time. I actually think we've got something more structurally wrong in Australia, and that is we've had very high home prices for a very long period of time, and that's all to do with too much credit being available. So I think the liar loans thing is a subset of a broader problem. I'm not sure it's a bubble, but they're way too high and they will correct. And I think liar loans is part of the problem, but it's not the only part of the problem.
Okay. Well, on my personal note, I do notice that a lot of housing bubbles and say like the South Sea bubble and things like that happened in the past had a lot of an element of Ponzi financing. So there's a gravity of leverage which was going into the system. And do you see that has the makeup of or the empirical data that's showing you that in the housing market?
Yeah, there's no doubt that we've got significant over leverage. I think the investment sector is a good area to look at, right? Because if you look at that, we've got typically portfolio investors have multiple properties and perhaps 6 or 7 or 8, and they're all leveraged off each other. And on the way up, effectively that works well because effectively you create equity in the first property, that goes towards the second, to the third. And if you then overlay interest-only loans over the top, because effectively you can reduce the payments you have to make, you can build yourself a little mountain of 4, 5, 6 properties, all of which can create more value if capital gains go the right way. But the reverse is also true, that effectively if prices start to fall or if interest rates start to go up or if interest-only loans get blown up and you can no longer get them, essentially that all comes crashing down. So I think the investment sector is the first area of Ponzi-like behaviour and effectively, significant risk, highly leveraged. The other side of it is we've got a lot of households who've got just an owner-occupied property and have still got a very high loan-to-income ratio. So if you think about what the loan-to-income ratios were perhaps 5, 8 years ago, they'd be 3 to 4 times. Well, there are many households there now with 7, 8, 9 times loan-to-income. Now, the reason they can do that is because interest rates are really, really low. So on the actual repayments, they might just be able to make it. But if you look at it carefully, they are still paying a lot more than they used to relative to their other outgoings. And they're so leveraged again. So if interest rates were to rise even 0.5% or 1%, that creates significant issues. So there's leverage there, there's exposure there, there's leverage in the investment sector. And I guess the other point to make is if you look at the average home price growth, particularly in the main eastern states, they've just gone through the roof in the last few years. And it's about 35 to 40% over where it should be on a long-term basis. So that essentially says that we have all the makings of a nasty correction happening sometime soon. And it's not going to take much to tip it over. And the question is whether it will be a local driven issue or whether it will actually be created by an international crisis coming in to hit the Australian economy. And I both those two scenarios are worth perhaps exploring a bit further.
Yeah, absolutely. Is the compartmentalization of regulators, badly automated systems, and the outsourcing of responsible lending the cause of these issues?
Yeah, I think there's a lot of interrelated things that have created the problem. The first is a fundamental philosophical question about the fact that banks can create ever more credit. So they've got no limit on what they can create. And that's, by the way, not a very mainstream view of economics, but I think it's the right view. So effectively, if the banks can find people to lend to, they can create the loans to be able to lend to them. So there's no limit to how far they can actually lend. The second point, I think, which is sort of part of the same puzzle, is that the regulators have been relatively slow to try and deal with this inflation in lending. And the RBA is doing it because essentially they believe that the only growth engine in Australia is household consumption and expenditure. So that's really been replacing the mining investment for a long, long time. And it's getting, to the point where now that housing cycle has driven debt to a very high level. Household consumption is still tailoring off because essentially people can only consume so much because they don't have the funds to go on doing it. So that's an issue there. And then the other regulator, APRA, is very much focusing on financial stability. And the recent productivity report made the point that, in fact, APRA is focused on financial stability against competition, and they really are only just now beginning to wake up, I think, to the risks in the system. So they came late to the party. And actually, I did some work a little while ago comparing what the regulators in Ireland said in 2006 with what Wayne Byers said recently here, and it's horribly, horribly similar. And you know what happened to Ireland. And then, of course, you've got ASIC. Now, ASIC's done quite a lot of work, particularly around responsible lending and not unsuitable loans. But effectively, they've got just a bit of the puzzle, and the RBA's got a bit of the puzzle, and I guess you could say the ACCC has a bit of the puzzle, and everybody's got a bit, but nobody has overall control of, if you like, the credit cycle and the credit boom. And then, of course, you've got this other challenge, which is you've got this Council of Financial Regulators, which is RBA, ASIC, APRA, and the Treasury, which means that the Treasury is in the middle of this, and of course the Treasury is after GDP growth. And guess what? Inflating housing and more household consumption helps to lift GDP growth. In fact, last time around, it was household consumption which was the strongest lever for GDP growth. What that tells me is that effectively everybody in that group who sort of take collective responsibility for what's going on at the moment bears responsibility for what's going on. But essentially no one is taking the hard decisions, and nobody wants to swim against the tide. So effectively we've got this continuous inflationary process around ever greater credit, ever greater house prices, in trying to get consumption to continue to run. And it's running out of steam, and we don't have a plan B.
So is this a bit of greed and negligence which is going on, or is there something a little bit more sinister?
Look, there's no doubt that if you line up the RBA with the property sector, with the banks, they all have the same interests, which is effectively to use household consumption and the property sector to continue to support growth, right? So they're all on the same side of the ledger, as it were, right? And the poor old household is on the other side and is just sort of going along for the ride, essentially, right? There is really not much to counterbalance all of those forces. So, not surprisingly, the real estate sector is saying, prices have dropped, great time to buy, despite the fact that almost certainly prices will go further. The lenders are saying, look, we'll cut our interest rates so that we can actually attract you to come back and refinance your loan with us. And in fact, the refinance rates have gone up and the interest rates for new loans have gone down a little. So you can see that happening there. You've got the building sector saying you need to build way more houses because effectively migration is still strong and there's an undersupply of property. That's not true. We have enough property out there. So the migration and property supply thing is a furphy when it comes to housing affordability. And so you put all this together and you see this sort of alignment of interests across the board. And by the way, if you add it all up, 60% of banks' lending is for mortgages. Add another 15% for the construction sector. So 75% of all lending is property related. 35 to 40% of all income into households is property related, either through construction or real estate or ancillary services. So this is a huge part of the economy. Another way of putting it is we've got so many eggs in the property basket that it's almost unthinkable for it to actually begin to sort of fall apart, because if it does fall apart, then you can see how significant and important it's going to be across so many sectors. So everybody's trying to keep the ball in the air, kick the can down the road, hope that perhaps we'll see income begin to rise a little so that households get out of difficulty. All of those things, I think, are in the mix. And I think, there is I don't think it's a coordinated necessarily thing, but it's everybody thinking the same and actually acting in the same way. But it's not the whole story, right? And so what I've been saying, I guess, relatively recently is there is another narrative here that we need to understand. We need to understand what's really going on. And we need to understand the risks in the system and how, I keep asking the question, how is this going to play out? Because we are going to get a correction. It's a question of how big is the correction, how immediate is the correction, and what is the real impact going to be? Is it really going to be as bad as Ireland or the US in 2007 and 8, or is it going to be less, or is it going to be even worse? But effectively, everybody is singing from a different hymn sheet, and it's a property-led hymn sheet.
As you know, the Royal Banking Commission is underway. What kind of outcomes would you like to see from this?
Well, of course, the Royal Commission is constrained, right, because it's carefully tailored to look at historical events, in other words, things that have already gone past, and they're not allowed to look at macroprudential or the regulatory framework around financial services. Now, that was absolutely deliberate on behalf of the government, I think. My own belief is that the Royal Commission's scope should be increased to include all of those broader questions. But let's put that on one side because that's not within their scope at the moment. So clearly, so far from looking at the lending side of it, we've seen significant issues with some of the big names in finance effectively breaking the rules. You could almost say breaking the law in some cases. But very importantly, they are clearly not doing the right thing by their customers. And for me, that's the critical change that we need to move to. What we need to be able to do is to be able to say to banks, look, yes, you understand that you're there to make a profit and a reasonable return for the shareholders, but you have also to do the right thing by your customers because they are ultimately the future success of your business. And so it's that customer lens, and it's aligning the systems and processes to ensure that customers get genuinely good outcomes rather than just being screwed over, which is what so many people have experienced, I think, today. So it's about a cultural change. It's about a realignment of sort of important priorities within the banks and the way that they interact. I think there's also some questions about whether the structural arrangements that the banks have, where they have these end-to-end business models where they own broker chains, they manufacture products, they sell products, they sell multiple products. I think we need to look at that, and my own theory would be that we would probably do better to have a series of smaller financial services entities rather than just 2 or 3 or 4 very large players. So maybe there's an angle there to think about teasing them apart and making them more accountable. And I think then the third thing is that, and this go back to the productivity Commission's observations. There are a lot of products that are quite similar but not very similar. ACCC said the same. It's hard to compare apples with pears because it's just slightly different. So I think there's an opportunity for product simplification, and perhaps we could end up with products that are easier for consumers to understand, more ability to switch from product A to product B with full transparency. So if we were able to bring some of those things to bear out of the back of the Royal Commission, then I think that will be good. They probably will also highlight some specific legal issues to follow through on. But I do think those cultural dimensions that I've touched on, and the customer centricity, is really the most powerful change that could be wrought.
Coming on the back of the Royal Commission, say if we were looking at mortgage assessments, if they were done to the highest degrees of accuracy, how much would lending be restricted?
Yeah, it's a great question. We know that already the mortgage power is down about 20%. UBS's research suggested it could be down by about 35% from where it was. So in other words, the loan to income would be 3 to 5 compared with sort of 5 to 7, 7 to 8, and the LVRs would be lower as well. So effectively, I think that we probably see typical mortgages down by 30 to 35% once this all works through. And think about the impact of that, right? If you suddenly cannot get a mortgage the size that you had, but it's sort of 75% of what you had, think about the impact of that on home prices. It could be quite significant. And I think even now the lending standards are tighter than they were a few months ago. But of course that only solves it going forward. What we have, this is massive overhang of households that are highly leveraged with essentially no visible means of support. So, solving the problem going forward is one thing, but we've still got this historic issue to deal with.
When you're looking at these applications, they're just writing the most minimal expenses, like they're like living on air, basically. And it's there's a lot of good earners out there. They're pretty much making it square, really. I wouldn't say a lot of people are very flash for cash generally, and to actually even have a savings rate and saving for a mortgage is a bit of a stretch for most people.
Well, you're right. So if you look at the savings ratio, right, that's dropping, and that's been dropping quite a little bit. So what are people doing is they're still wanting to spend, but they're dipping into their savings or putting more on credit cards to be able to do that, and that's unsustainable, right? Only half of households will have any sort of formal budget. So many households have no idea what they're actually spending or what they're planning to spend, and that's, by the way, a problem for brokers when they try and pin people down and say, well, how much are you spending? Many households have no idea, which is one reason why the HEM, the expenditure measure metrics, were being used, because effectively it gave you a baseline. But the problem is that the HEMs were just so basic. The typical HEM would be a lower level of income than, say, a retired couple would actually spend. So the HEM was just such a low base, which meant that effectively the banks could say, well, we've done our due diligence, it's a suitable loan, despite the fact that it's really, really low. So if that comes up to a more realistic level, that's clearly going to cramp people's styles when it comes to what's spending. But yeah, the key point is many people have really no idea what they're actually spending, what they're actually, what their free cash is. And we look at our household surveys, right? So we survey 52,000 households each year. We know from that we've got about 60,000 households in mortgage stress at the moment from an income cash flow perspective, simply because they don't actually have any way of being able to handle money in, money out, and still having some left at the end of the month. And that's a really big problem. That's 30% of all owner-occupied borrowers. And that's with interest rates really, really low. And of course, the expectation is that interest rates will rise, not least because of what's happening overseas, particularly in the US, with bond rates and with the LIBOR rates and with the BBSW here. So effectively, we're going to see mortgage rates rise. Many people just don't have the cash flow to handle it. So that's a big issue for us.
Living beyond our means. So that's just, we're looking at the finances of the people. Now, let's look at the finances of the banks themselves. Now, just a couple of the products that get sold out there. This is for the means of bank funding. Covered bonds, which are kind of dodgy because it's actually the investor that becomes at the front of the queue instead of the depositor when things go belly up. Also, Deutsche Bank's been well known for cocoa bonds. So whenever they find themselves into a bit of bother, they cannot pay their investors, so instead they provide them with shares, which are declining at the same time. So the means of this funding is a little bit rocky, isn't it?
Certainly is. So, it's worth just teasing it apart a little bit, right? So effectively, the banks have a higher share of their loan portfolios backed by deposits than they used to, but around 40% or 35% are still actually covered by funding from other sources, and that will include most often all sorts of flavours of bonds, including, as you say, covered bonds, and other financial instruments, mostly in the capital markets. About half of the, let's say, 450 billion that the finance sector has raised in the last 12 months is overseas, particularly into big markets like the US and into Europe, which gives you risks in terms of exposure and also in terms of interest rates going up there. Within that, there's quite complicated structures, and there's been some different innovations around how to actually create different classes of investments to be able to count them as different classes of capital. And so some of these convertible and hybrid convertible things, which, by the way, I think many investors may have bought and then haven't really understood what they've got actually. So it's pretty complicated, the treasury operations of banks these days are remarkably more sophisticated than they used to be. We've got a long way off, traditional banking. But it's worth saying, by the way, that the traditional model of you start with deposits and then you lend is completely wrong. What you actually do is you start with lending, and you might create deposits in the process. So effectively, don't think that deposits is effectively a limiting factor on the bank's ability to lend. But these financial instruments and the financial engineering behind them are certainly quite, I think, concerning and difficult to navigate. The other point, of course, is even the securitization there. So effectively, parceling up parcels of loans and standing them off and creating more capital that way. And the securitization markets come back to life now, and in fact some of the non-banks in particular are using that mechanism quite a lot. So big, complicated. Interestingly, the net margins that the banks are operating on are a little lower than they used to be, and there's been a little uptick in recent times because they've repriced a lot of their loan portfolios thanks to the regulator saying, feel free, there are higher risks, and of course they blame the regulators, despite the fact that the recent review from ACCC said, no, actually the main reason that you repriced your loans was to increase your profit. So net margin's a little bit up, but it's now being compressed. And the BBSW, which is up sort of 22 basis points from where it was, is signalling higher funding costs ahead. So it's complex, lots of different factors involved. And I think that we're going to see a lot of funding pressure on the banks. And of course, if things start to go wrong, if default rates start to rise, then effectively the risk premium that will be required to be able to source future funding will be a lot higher, and that will again become part of a vicious circle.
Do you see these two elements as being the major problems for Australian bank funding? And that is an asset book which is graded too high for what is underlying, dodgy housing, underlying loans. And then on the other hand, you've got central bank asset purchasing, which is like the quantitative easing, which is tapering off a bit, but can't continue forever. So in the vacuum of them being like the purchasers, that means that the investors need to step in and they will demand higher yields, and thus interest rates will rise. So do you see these as compounding issues?
Yeah, there's no doubt that interest rates will rise because of the risk premium and because of the exchange rates movements. It may well be that we will import inflation down into Australia as well. So for all those reasons, there's no doubt that the rates will rise. Also, what's interesting is, and I've sort of had a few phone calls over the last month or so from the international investors who look at Australia and are trying to work out how much risk there is in the system here. And, the story always used to be, they'd always say, no, it's not really that bad, is it? Because effectively the loss rates on the mortgage book are, 2 basis points. It's really nothing. And there's still demand for housing and, funding costs are low, et cetera, et cetera. But now that's all changed. So a lot of the investors that I speak with now are saying, we're actually quite concerned with the risk profile now in Australia. We think that the risks in the system are higher. We think that the liar loans thing is a real issue. And so they are looking for higher returns on those investments. And interestingly, my own modelling, which for years has been calling out these risks in the system as being much higher than what the RBA was saying, or indeed the banks themselves are saying, well, now suddenly all of the people that I speak with are saying, yeah, we think you're probably more right than they are, which is quite interesting, right? So effectively, yeah, risks in the system are now much more perceived to be higher. As a result of that, no doubt in my mind that prospective investors are going to look for higher returns. That's going to put more price pressure on funding costs, and that's going to lift the need to put mortgage rates up. And of course the banks will resist that to an extent because of the current publicity around them and around their behaviours. But at the end of the day, the tyranny of rates will mean they'll probably have no choice. It's just a matter of timing and when and how they do it. The other side of the coin, of course, is they can reduce rates to depositors. And that's the untold story. If you look carefully, you'll see that the rates on deposits have gone down and down and down in the last 18 months to 2 years. And in fact, a lot of the margin recovery that the banks are now able to report is nothing to do with loan repricing. It's all to do with squeezing deposits further. In other words, depositors are being forced to take the hit at the moment. And that's another factor that I think probably should be brought out. And I'm not sure that anybody, not even the Royal Commission, is looking at that. So that's another, if you like, sleeping issue that could come out.
Absolutely. Just what pops into my mind there is that saying that even in the old times, the reason why you'd give up your money is that you're actually getting the interest in return. And obviously you've got the security measure and stuff like that. But then it does give you this little inkling of thinking, well, people could just withdraw out their cash. They're not making any interest, so they might as well just have it in cash anyway. I know you can't quite transfer and electronics and all that kind of stuff, but it just does make you think in those respects. Just on the situation of if and when things go bad, the dreaded banking write-off, where the asset turns into a liability and their resilience to withstand this gets, they have to absorb it until they're basically bankrupt. What is their margin of error with these write-offs?
Yeah, well, it's interesting because, of course, historically, the loss ratios in Australia are remarkably low, right? I mean, lower than almost anywhere. And there are three reasons for that. Firstly, lenders have LMI, lenders mortgage insurance, above 80% loan-to-value ratio, which means that they can actually call on the lenders mortgage insurers to be able to fill the gap. Secondly, they're actually quite clever at encouraging people to sell their properties if they get into difficulty rather than foreclosing on them. So if you can encourage a borrower who's in difficulty to effectively put their property in the market and sell, in a rising market, essentially the loan is repaid, no issue. So that's one of the tactics that is used quite often. So that means that the number of loans that really come through to being really bad and therefore have to be disclosed as non-performing is extremely low. Now, that could change quite quickly if, in fact, the default rates start to rise. And Moody's came out with a report today that suggested that they felt that default rates will rise over the next few months because of all the issues we've been talking about. And I've got the same in my modelling. So I'm expecting default rates will rise. So there is a tipping point at which effectively the banks will not simply be able to absorb those losses without actually beginning to report them in a way that actually gets people a bit twitchy and a bit concerning. Now, the other side of the equation, of course, and if you look back to the GFC and what happened there, it was effectively the funding around loans that triggered the broader crisis, because effectively it became a liquidity question. And as the liquidity dried up, suddenly people who had deposits with those banks thought, maybe I should grab my money and run. And, you may remember back in 2007, there were videos in the UK of Northern Rock with all the people queuing outside, waiting to get their money, and they went to try and get it out via the online system, and the online system would no longer work. And even when the UK government said we're going to back Northern Rock, depositors still wanted to get the money out and run. So there's a confidence thing there as well. So my point is there is a cycle of potential defaults which may rise, but there is an inflection point when effectively this moves into a whole new ball game, when it's more about financial stability and about safety of deposits. And at that stage, there could be some significant problems here in Australia, in my view.
Yeah, just funny you mentioning that, because I remember I had savings in Bradford and Bingley, and I went over exactly at that time when it was all happening, and I was like, can I withdraw my money, please? And then they asked me a number of questions, and they even said, oh, we're very, like, we're doing quite well, and I knew something was up with them as well, so I withdrew my money at that moment. But it just makes you go, bank runs on.
Well, it's interesting because one of the questions I get more than any other on the video blog is, where is a safe place to put my money?
Yeah.
Right. And I have to keep saying, well, actually, there's no such thing as a completely safe place, because even if you put it in your mattress, the mattress could catch fire and you could lose it all. Yep. Right. It's a quantified risk, right? So do I hold it in the bank? Do I hold it, in some other, in some form of just crypto or whatever it is? Almost wherever you decide to put your money, there is an element of risk attached to it. And interestingly, if you ask people about the risks of holding deposits with the banks, most of them will say, well, I can always get my money back, can't I? There are no risks. But of course, there are some risks. It's just that people don't really sort of have visibility of what those risks might be.
Yeah. One thing you do actually excel on is you talk about household stress. Now, that is very sensitive at the moment, as I get from the data that comes through you. Looking at historical bubbles, there seems to be like a very long holding off period before a sudden collapse. Does your data suggest that the mortgage servicing is hanging by a thread?
Yeah, so we've got 960,000 households who, from a cash flow perspective, have no wriggle room at all. And within that, there is around 22,000 to 23,000 households who are in what I call severe stress. In other words, they've got a severe deficit. Running my modelling forward, I think that means there'll be about 55,000 households who will default in the next 12 months. If you run a scenario with interest rates up 1% from where they currently are, and that would still be below the long-term average, then it moves up from under 1 million to about 1.2 to 1.25 million households, right? And if you run it up to 2 to 2.5%, which will begin to get to the average long-term rate, then half of the population would have difficulty servicing their current mortgages. Now, that is a really, really problematic scenario, because you've got no income growth at all, you've got the cost of living rising, and you've got interest rates potentially rising, all of those things working in the wrong direction. So there is no get out of jail card. If you look back to the early 2000s in Australia, we had quite strong house price growth and strong lending, but we also had income growth running very strong as well, which meant that you could actually extend yourself on day one and get that mortgage, and the payments would be troublesome for a year or two, but then they would get easier as incomes grew. Now, this time around, we have no growth in income and no prospect, in my view, of incomes recovering anytime soon. So we have a long-term problem here with that degree of debt, and everything that I'm seeing suggests that interest rates are going to rise, which means that more households are getting in difficulty. There's a second order impact to this as well, not just about managing those mortgages, but if households have less disposable income, it means they can spend less at the shops. And I think it's that second order in economic income impact. In other words, people have less money to spend, which essentially means that they're actually not going to spend down the shops, which means that the growth that the Reserve Bank is looking for out of the household sector from consumption will tailor off. And that basically means that we have a significant economic problem, which is broader than just the housing sector, on the back of it too. So if rates start to rise, it's that second order impact which is probably most concerning. And by the way, that's one of the reasons why I think the Reserve Bank is being very coy about interest rate rises. They're basically saying, well, the next rate rise will probably be up, but it won't be for some time, because they don't want to scare the horses and they don't want to put more pressure on households.
Yeah. So in your opinion, somebody who's been sitting on the sidelines watching the housing market chaos unfold, they've put off having a family, they've been good savers, the prudent ones in society. Should they be affected by the fallout?
Yeah, it's an interesting moral hazard question, isn't it, really? I mean, if you didn't participate in the housing boom and, get the big loans because you actually genuinely believe that it wasn't a good thing to do, on one level, you might feel that you've been disadvantaged. In fact, I had a message today on the blog from one person who said, look, I've sat on the sidelines for years and years and years, and I feel very strongly that I've done the wrong thing now because prices kept going up, and I guess timing is always the question. You can't predict timing. But what you can say is that in a situation where effectively things start to fall apart, as it's my belief that we are going through that phase now where things probably will get more wobbly rather than less wobbly going forward. The households who have actually not got themselves into a massive amount of debt should be well positioned beyond that. And, what will tend to happen is that the people with the really big loans will be the ones that get into trouble first. And they will be the ones that will probably get bailed out one way or the other. So, for example, the loans will be restructured, or maybe there'll be a government initiative where they will buy these stress loans. And I guess that's the sort of the moral hazard. It's almost, if you do get a big loan and if you do hold it, then the chances are that somewhere along the line they have an expectation that they'll be helped out. The truth is that if things go really badly wrong, then I can't see how that assistance is going to play out. So effectively, we could have a lot of households with very significant issues in terms of loans they can't service. As prices slide down, of course, you also have households moving into negative equity, and that negative equity means that effectively the loan is worth more than the property. And if you look in the UK and Ireland, there were people who were stuck in those properties for many years waiting for the values to recover. And in fact, I got a message from somebody in Ireland the other day saying, hey, my house has just recovered sufficiently so I can now sell it without being in negative equity. So this is a really painful discussion to have, right? And the people who haven't bought in, yeah, you may have missed a boat or two. But remember that for those people who are holding property at very inflated levels, it's only a paper value until you come to liquidate those assets. And if prices begin to slide down, your paper value and what you actually can get could be a lot lower. So maybe the gap is not perhaps as big as you might first think.
Yeah, it is a complex matter. Now, I've noticed on one of your videos you mentioned about the Chicago method, and you must have heard of Steve Keen's suggestion of a debt jubilee. Do you think there's any justifiable way to get out of this mess?
Well, I think the first thing to say is we can't go on doing the same thing. In other words, using credit to drive growth, to drive credit, to drive growth, and expect a different outcome. And that outcome is boom and bust, boom and bust. We've seen it a number of times now, right? And by the way, the longer the boom cycle, the bigger the bust, right? And if you look at all the housing crashes and financial crises around the world, as I've done, it's a consistent pattern. So the current model has designed into it this boom and bust thing, and effectively there are always significant losers. So if you start from the assumption that the current model is broken and there is no way that you can patch it to make it work, and I also mean things like the Basel capital ratios and the way that central banks try and control inflation, all of those things, to my mind, all of that's bust. So then we need a new model. And then the question is, well, what are the options around new models? And, there are a few floating around. The Chicago example is one where effectively you run a process to be able to effectively take a whole bunch of debt away and separate the functions of banks into two different ones. It's quite compelling in some ways, although there's a bunch of questions about how you'd execute it. One of the things in the Chicago one and in Steve's too is that effectively you've got to find a way of relieving the debt burden on households, because if you don't, then you will have a generation, 20 or 30 years of households that are completely debt-ridden. And that is a complete break then on productive investment and the broader economic future of the country, or indeed the planet, I guess, if there are enough countries in the same boat. So in a way, the debt jubilee, or the removal of the debt from households, is a circuit breaker to try and move to a different economic basis into the future. But we have to actually understand that this is not without pain, and there will be winners and there will be losers. But it's trying to architect a future economic structure that is just more sustainable, less inflation-driven, less credit-driven, more opportunity to be able to invest in productive future areas rather than just inflating housing and creating more housing bubbles. So, it's not without not without its problems. But I think the time has come to recognise that the current mode of economic thought around here, and by the way, the economic thinking in most central banks, is just not up to the job. So time for some new thinking. And I'm with Steve. I think there's got to be a way of thinking hard about how to change the debt burden into the future to be able to deal with some of those issues.
But do you think it's not going to happen until everything's got smashed down and we're on ground zero?
Well, I'm not sure, you see. I mean, there is an argument to say if you preempt what is likely to happen, you could actually make the transition. If I take Chicago as an example, you could actually manage the Chicago transition before there's a crash and actually manage that transition so that effectively you're dealing with the debt problem as part of that transition before the crash, right? But there's a limited window. We've probably got 18 months to 2 years before this thing comes home to roost. So you'd have to start now and start some formal planning. And, my dialogue around this particular initiative shows me that there are a lot of people who just don't believe that there's any way out of the hole that we've dug ourselves. It's interesting. I don't know whether you saw today, but the Australian published my blog on this as an article in the Australian under my byline, which I thought was really interesting. So it went slightly mainstream today as an idea, and maybe there's enough momentum now to begin to at least explore it. But I don't think we have to wait for the crash, is what I'm saying. I think we could begin to chart an alternative route now, and I think if we had enough smart people in the room, we could chart a way that perhaps would take some of the pain away.
Now, just on a geopolitical side of things, if you look at the globe, I know this has died off a little bit. So there's the talk of the trade war where China holds an ace card with the US treasuries, which could be dumped to the market. And that's turning around now because everyone's thinking now potentially they're going to try and buy more treasuries and lower the value of their yuan so that they can have better export advantage. So that thing's dying off, but now you've got war kicking off again for some reason. Syria's using chemical attacks. The environment is very rocky and it's moving quite rapidly. And I have these opinions that sometimes just before economic problems, you have distractions that happen at the same time. I always wonder as well, just as a Fed chairman changes hands, then they can probably have problems around that time. So there's a lot of synchronicities and news stories which are happening, which could be the beginning of maybe a black swan event. So do you feel that there is a lot of uncertainty out there and something that could manifest, which could put Australia in peril?
Well, I sort of run 4 scenarios in my modelling, right, from a relatively benign and limited local problem through to a global catastrophe, which would include the geopolitical tensions that you're talking about. My own reading is that, there are some very significant issues out there, but they're probably being overstated by some commentators at the moment. I put about a 20% weight at the moment on that sort of nightmare scenario, which could be trade war or it could be a real war, where effectively off the back of it, house prices drop 40% and a lot of people get into significant difficulties. It's certainly not the only scenario, but I think it's worth thinking about it. And if I were in a strategic role somewhere, I'd be thinking about that as one of the scenarios to war game, if you like, and think about what you would do. It's not actually my most central case at the moment. I'm sort of a little bit more optimistic than that. I think that we'll probably muddle through some of those international issues. I think the trade war is probably relatively limited. I think what China said a few days ago was quite helpful. And, the IMF recently said we are a global, economy, like it or not, and therefore, there's a limit perhaps to how much you can pull back from that without teasing it all apart. So, I think it's one scenario, but it's by no means the only scenario. And in fact, I would probably home in more on some of the more local grown problems, particularly this issue of the high levels of debt here in Australia, the low levels of income, the prospect potentially of legal action to the banks on the not unsuitable loans axis, and a few other things there. So I think those would be some of the triggers I'd be looking for. I'm not quite so worried as some people on the global sort of playing field. So yeah, my black swan is probably a bit grey rather than pure black.
Just one thing that was popping into my head actually today, there was that in the old days, people had a job for life, and if you lost your job, you could quite easily get another job. People get involved in a 30-year mortgage. Things are getting automated, and people were saying now it's the new gig economy. Do you see there's a lot of imbalance there?
Yeah, there's no doubt that the mode of work for many people is different than what it used to be, right? So there are more households with multiple part-time jobs, gig economy jobs, or just part-time jobs. A lot of those jobs, by the way, the new ones that the government keeps claiming have been created, the 400,000 plus. A lot of those are relatively low paid and even many part-time jobs. So the nature of work has become fragmented and fractured. And as you say, there's also the whole question of automation and other things. So the mode of work into the future is going to be very, very different, which is, by the way, one of the reasons why I'm arguing that we need a reset around the whole question of house prices and debt and all those things, because effectively the previous model where it was, as you say, job for life, and you went on the bottom floor and you went up nearer the top and your income grew, and then you had your superannuation to see you through later life, and that's just a model that for many people will never be pursued effectively. So yeah, I think we need to think quite carefully about the different modes of work and the different implications of that. And many young people, and I sort of run workshops with quite a few younger people about what they're thinking and what their aspirations are, and they're actually got quite different aspirations. So in some cases, owning property is not high on their list. They want to do other things first. In other cases, they definitely don't want to be locked into full-time work over a long period of time. So there's almost a set of cultural norms that I'm seeing, as well as the economic norms which are changing. And I think the nature of work into the future is going to be quite interesting and certainly quite different. I think at the other end of the spectrum, those who are older are more likely to continue to do some part-time work into much older ages than previously. So for me, there's this much more fluidity around the whole work environment, but it's at a time when work is less certain, when income growth is less certain, and therefore there are more uncertainties surrounding this whole area.
Do you watch the CEC report on YouTube at all? Because I think they've done an excellent job on Australian legislation that got passed, stating that any other instrument can be used for protecting financial stability. I found the whole episode and how they were trying to press for the government to do that very interesting. What's your opinion of that? Should the public be concerned?
Yeah, so the whole bail-in question is quite an interesting one. Yeah, I think the CC did a good job of raising it and tabling the concern. So the background here, of course, is that the legislation which was effectively brought into Parliament to give APRA extra powers to deal with the situation where a bank is in difficulty included this little clause which said that they could grab any other instrument. And then the question is, does any other instrument include deposits or not? And if you look at New Zealand, which has the most clear bail-in rules around the place, it's clear that in New Zealand you can grab deposits to protect depositors as part of a restructuring of a bank to stop it effectively falling over completely, right? Now, in Australia, we don't have such clarity there, and of course the legislation went through Parliament, was nodded through, and there was also another initiative to try and actually specifically exclude deposits from this any other instrument clause, but it was not actually allowed in the bill. So we have a bill at the moment that specifically says any other instrument is available for bail-in. So you could read that as being including deposits. Now, Wayne Barrs recently gave evidence and said, no way are we going to grab deposits because we're looking after the interests of depositors, and essentially APRA's responsibility is to protect depositors. Then you ask the question, well, is there a difference between deposits and depositors. In other words, if you had to raid deposits to protect depositors, could you do that and would you do that? And I think the bottom line is it's not clear. And in a crisis, it could well be that APRA could step beyond perhaps the things that they would prefer to do to effectively grab deposits. So my own view is it's not clear, and I can't really tell whether it's angels on the head of a pin. Is there a difference between deposit and depositors, or whether there is something more material here? But it amazes me that legislation was nodded through, and that alternative amendment would have actually clarified deposits and the role of deposits in the bail-in process was deliberately, in my view, not included, which gives them wriggle room. And that's the way that Australia operates, with a lot of flexibility, a lot of wriggle room. So these regulators have massive powers, but they don't want to be controlled or constrained by them. So I think we should be concerned, and I think that people should ask hard questions about the bail-in provisions that currently exist.
Yeah, because we talked about the low interest rates. Now we're talking about potentially they could be, they won't be taken away, but what they'll do is they'll do limited ATM withdrawals. But it does give you that kind of thinking about cash underneath the mattress.
Well, it goes back to the fact there is no such thing as a completely safe place to hold your money, right? In New Zealand, the Reserve Bank there, as part of their discussions around this bail-in process, said depositors need to actually weigh up the risks of holding deposits in different organisations. Now, I don't know how on earth you would do that because, as an individual, how would you know whether Bank A or Bank B is more or less risky? So it seems to me that it's a bit of an impossible task. But the fact is, the bottom line is, there is no completely 100% secure location. And by the way, deposits in Australia, in theory, are protected up to $250,000, but that deposit insurance or protection is not actually activated until the government actually enacts it for a particular bank. So it's a theoretical protection at the moment, and it would only be activated at a point in time, which then begs the question, well, if APRA got in first and did some bail-in deposits, how does that work? So, and again, more questions. But $250,000 protection is not in place now. It's a theoretical protection that the government would need to activate. People need to understand that.
Now, on the trusted party, so the trusted party involved in this is the bank. Mm-hmm. Potentially, the trusted party seems a little bit untrustworthy. Now, with this erosion of trust, do you see this falling in the hands of the trustless party system, which is blockchain? Now, obviously, it's not looking too rosy because the bubble, the speculative bubble's popped and it's gone down, so everyone's repricing and evaluating things again. But there is incentive measures of saying, okay, well, regardless of what goes on, I do still possess these digital numbers. Whereas on the other hand, I don't know what's going to happen with these digital numbers on this in this other account. Do you see that there is some areas of where you take full ownership that's a positive?
Yeah, so I've been doing a lot of research on crypto and blockchain, and I keep saying I'm going to do a blog on this, but then I keep finding more things to research. So at one stage I will. But look, let's be clear. There's a difference between Bitcoin and blockchain, right? Bitcoin is a manifestation of effectively system that uses blockchain, but blockchain is much broader than Bitcoin, and there are many other digital currencies. The thing about these digital currencies is they are effectively, in a way, immutable because effectively you don't have any central registry. And that means that effectively there's no central entity in control, which gives you, much more robustness potentially, but there's also a risk of hacking and all those things. So it's not 100% bulletproof. The blockchain itself can also be set up as either a centralized or a decentralized model. So just because it's blockchain doesn't mean it is naturally decentralized. It can be one or the other. Yeah. So that's something else to bear in mind, because essentially there are models around where you use blockchain back to a central repository, be it an Aussie dollar, say, or something else. My own view is this. I think Bitcoin is a speculative venture at the moment and is unlikely in the long term to become a currency in its own right. I think the underlying technologies and the concepts around blockchain does have a potential future, and then it becomes a question as to whether it's going to be a centralized or a decentralized future. So will the RBA ultimately create an e-currency, for example, that becomes effectively the next generation of our currency that has all the benefits of its e-ness, but also some centralized control? Or will it be a devolved currency, some evolution of Bitcoin or something different? It's probably too soon to say. My own view at the moment is that none of those cryptocurrencies that are out there really will stand the tests of being fully defined as money. So they are speculative. But that isn't to say that there won't be another generation that could become more robust and therefore potentially more like money down the track. So that's my sort of take on it. I think we're at an early stage in early evolution. I certainly think there's a temptation for people to say, well, I've given up on the old models with money in banks because I can't trust the banks and they could bail in. So maybe I'll chuck the money into Bitcoins and at least there's an alternative. I would say, yeah, but that's probably pretty speculative and quite risky. So be a little bit careful. What I say to people is, yeah, sure, feel free to invest in Bitcoins, but assume that you're going to lose it all because you could well.
In the sense that there probably will always be a price. I'll collect them all if nobody else wants them. But I think just going back, I think there's probably a lot of listeners probably are fairly similar to me, and they look at different avenues, and probably you're the same as well. In terms of I look at precious metals, that's always been a safe haven throughout time, especially crashes and bubbles. That might be taken down a little bit when the crash happens, but then it will soon rise afterwards. And then I'm thinking to myself, and this is long ago when it started pretty much, I saw, actually you can't confiscate this if you take possession unless the government raids your house and they manage to get your private keys. And also they can't inflate away the actual the monetary value. If something's been set there, say 21 million bitcoins, then that can't be inflated away. So there's those two little aspects which are going on there, which do appeal to the gold bugs as well, and the people that are libertarian thinking.
No, I think you're right, and like I say, I think there are characteristics which are quite attractive, right? I just think there are also some significant downside risks as well, which people need to be aware of. And the fact is that nobody knows what the true value of a Bitcoin or a bit of a Bitcoin is or will be. It could be close to zero. It could be very large. It could be somewhere in between. And in a way, that's a bit of the problem, because normally when you talk about money, you've got some view as to what that is worth at a point in time. Hard to do that with Bitcoin. But I agree with you also that those digital signatures, which are unique and cannot be just nicked, and there is some attractiveness to that. So like I say, I think there are some characteristics which are interesting, but I'm not convinced that what currently exists is a fully formed alternative to our standard economic system at the moment. May later evolve to it, but I think it's very early days.
Sure. Just one more little question. I'll just really be fascinated to hear your thoughts on this. Now, you would say that the bond market, with the quantitative easing just getting gradually tapered off, and then the financial market having to take the wind of this, and then you've got a lot of government-issued bonds or treasuries by the US. They can't necessarily continue because of all these unfunded liabilities. The bond market might have a little bit of disruption in the future. And then in that disruptive phase, that potentially could, obviously bonds are known, especially high-grade government bonds are the safe haven. Could you ever envisage a situation, I know you're going to have to really jump into some kind of imagination here, where bonds are deemed no longer a safe haven, and then people try and find a way out of that?
Well, it's an interesting question, right? So the theory is that US Treasury bonds are, the most risk-free investment that you can actually make, and there is an extent to which that's still true. Although if you look at what's happening to the yields and therefore the prices of the bonds, the yields are rising as interest rates rise, and in fact there's some interesting shapes in the yield curve at the moment with some inversion going on. So it suggests to me that there's some uncertainty about where this is all going to play out. Bear in mind also that government bonds are fundamentally linked to the amount of debt in the system, and an expectation I have is that US debt will climb considerably, particularly under Trump, and that could put some interesting pressures on the credit performance of some of those bonds. I think there's still truth to say that the government-backed bonds around the world will for a long time probably still be the most secure alternatives in terms of investment. But I think there are some risks in the system. And if you argue for a likely global economic resetting, maybe because of war or trade or something else, then in a way all bets are off, because essentially the standard economic parameters within which we operate may change, and in that situation maybe bonds will be nowhere near as risk-free as perhaps people would say. But at the moment I still think they're holding their own, although, as I say, yields are rising, and that, by the way, is a very significant bellwether for some of the risks that I see down the track.
Yep. Okay, so final question. Ruling out the black swans, could you provide the most probable outlook for the Australian market, and if possible even timeframes? I know that's what nobody likes to give, but timeframes as well.
Okay, so I'm penciling in 2019 as the year, as it were, when all of the bits and pieces flow together and create a bit of a problem for us. So my central case at the moment is I'm expecting home prices by that time to be 15 to 20% down on where they are currently. I'm expecting default rates to be higher. I'm expecting inflation to be a little higher because of the fact that we've imported inflation from the US. As a result of that, the Reserve Bank has had to put interest rates a little higher. I'm expecting unemployment to be a little higher than it currently is, and I'm expecting our GDP numbers to be pretty shaky. And the reason for that is that I don't see where our growth is going to come from. It's not going to come from the household sector. It's not going to come from the mining sector. There's only so much infrastructure investment that the government can fund, and we haven't got a real growth strategy in my mind for the broader economy. I think household incomes are still going to be languishing. I don't think there's going to be growth. And I do think that we're going to see a lot of political instability. I would be not completely surprised if Labor got in at the next election. And of course, they've got plans with regard to negative gearing and other things too. That would actually just add a little bit to the fire, as it were. So that's my sort of central case, right? So in other words, it's not the same as Ireland or the US, but neither is this a steady state. We'll be okay just drifting along, and there might be a 5% change in house prices. It's something more severe than that. And there is definitely more risk in that case on the downside than the upside, in my view. And if we have international pressures, if we have more geopolitical instability, then effectively the risks get a bit on the sort of heavy side, as it were. But that's sort of my base scenario. If that plays out, then I don't think the stock market can possibly stay where it is. So I'm expecting to see some correction then over that time frame too. So check back in 2020 to see whether in fact I was right, or whether in fact we hit yet another record and house prices went up 20%, in which case it's only an economist's view. So, it can be right or wrong. Who knows?
Yep. Well, I for one, and I'm sure loads of other people appreciate the amount of videos that you're pumping out at the moment. How many hours are you putting into this a week? It's amazing. I've never seen industriousness kicking off in such a way.
Well, of course, the point was I've always been doing the analysis, right? And I've been doing it up on the blog. The difference is I'm now just recording the video. So effectively towards the end of the day, what I do is I'll record 1 or 2 videos based on the work that I've done through the day. So actually the video production side of it doesn't take that long at all because I've got it all set up and it works quite well. The analysis I do anyway, and I've been doing that for many years. So what's new is the focus particularly on the YouTube channel, because essentially I hadn't really appreciated how powerful that channel was and how intelligent the discussion has been with the community on the channel. I mean, I've been absolutely amazed at the quality of the debate. So to my mind, it's a really rich resource, and I've learned a hell of a lot through that and through the interactions. And in fact, now some of those interactions are setting the agenda for my research programs. So it's a really interesting sort of synergistic relationship. And, producing the videos is, it's quite fun as well. I quite enjoy doing it. So, yeah, expect more videos. I may sort of ease back a little bit now, seeing as I've got a few other things to worry about too, and I've got clients and work to do as well. But no, I hope to continue to be productive on the YouTube channel for as long as people find it useful and for as long as the quality of the interaction continues.
One of my little habits, I always like to check my YouTube feed, see what any interesting videos coming up, and the algorithm seems to work quite well when I get something. But you always pop up, watch it straight away. Definitely most appreciated. The frequency is amazing. You don't get anything like that. So thank you very much.
Well, thanks. And look, I've tried deliberately to differentiate a little bit, not only with the shirt, but also with the style of presentation and the way that I try to sort of give the facts, right? Because I think the facts are really, really important. There's a lot of opinions out there, but if you can build the opinions of facts, then you can make your own decisions. So I'll always be fact-based. I will express my own views about things as well, but you get a lot more. You get data and you get information and hopefully insight, and that's effectively what the value proposition that I've tried to craft is.
Absolutely. Well, thank you again, and I'll definitely be in touch with you in the future.
Good to talk to you, and thanks for the opportunity.